In every boardroom decision, every critical investment choice, and every carefully crafted business strategy, there's one universal language that speaks louder than words, transcending cultural and geographical boundaries. It's the language that underpins the very foundation of commerce and finance. This language provides clarity, offers insights, and ultimately drives informed actions. It's the silent narrator of every business story, revealing the true narrative behind the numbers. Accounting, the language that translates every business action, from the smallest transaction to the largest merger, into tangible financial results. It's the lens through which we view the economic health of an organization, providing a clear and concise picture of its performance. More than just numbers, accounting tells a story of growth, efficiency, and sustainability. It's the backbone of financial reporting, ensuring transparency and accountability in the business world. From small startups taking their first steps to global corporations dominating international markets, every economic entity, regardless of size or sector, relies on accounting to meticulously track performance, analyze trends, and ultimately guide strategic decisions. It's the compass that navigates businesses through complex financial landscapes, helping them to make informed choices about resource allocation, investment opportunities, and risk management. Without accounting, businesses would be adrift in a sea of uncertainty, unable to chart a course towards success. The American Institute of CPAs, a leading authority in the field, defines accounting as the art of recording, classifying, and summarizing transactions in terms of money. But it's more than just an art. It's a science, a discipline, and a critical function that ensures the integrity of financial information. This definition highlights the core processes involved in accounting, emphasizing the importance of accuracy, consistency, and objectivity. It's a framework that provides a common understanding of financial performance, enabling stakeholders to make informed decisions. It's a systematic process, a carefully orchestrated sequence of steps. First, identifying relevant financial transactions, then accurately recording those transactions in a journal. Next, classifying them into meaningful categories, then summarizing the data into financial statements, and finally, communicating that vital financial information to stakeholders. This process doesn't end with communication. It also involves analysis and ultimately informed decision-making. Each step is crucial to ensuring the reliability and usefulness of accounting information, providing a solid foundation for sound business practices. Accounting's first objective: maintain systematic records of every financial transaction for complete traceability. Second, determine profit or loss by measuring operational efficiency over specific periods. Third, provide crucial information to stakeholders, investors, creditors, managers, and regulators. But accounting has limitations. It's historical, like looking in a rearview mirror rather than through the windshield. It only captures monetary data, missing critical qualitative factors like customer satisfaction and employee morale. The world of accounting is vast and multifaceted, branching out into specialized areas that cater to different needs and purposes. At the heart of it all lies financial accounting, a critical discipline focused on creating standardized reports. These reports are meticulously crafted for external users, providing a clear and concise picture of a company's financial health. Think of shareholders eager to understand the value of their investment, lenders assessing the risk of providing capital, and regulators ensuring compliance and protecting the public interest. Financial accounting adheres to strict guidelines and principles, ensuring transparency and comparability across different organizations. It's the language of business, spoken and understood by stakeholders worldwide. These standardized reports include the balance sheet, income statement, and statement of cash flows, each offering a unique perspective on the company's financial performance and position. Financial accounting answers a critical question, a question that resonates with anyone who has a stake in a company's success. How did the company perform over a specific period, and where does it stand financially at this very moment? It's about providing a historical perspective, a snapshot of the past that informs present decisions and future strategies. By analyzing revenues, expenses, assets, and liabilities, Financial accounting paints a comprehensive picture of a company's profitability, solvency, and overall financial stability. This information is vital for investors making investment decisions, creditors evaluating loan applications, and management teams charting the course for the future. It's the foundation upon which sound financial decisions are made. But the story doesn't end there. Delving deeper into the inner workings of a company, we find cost accounting. This branch takes a more granular approach, meticulously analyzing production costs to support internal decision-making. It's about understanding the true cost of doing business, from raw materials to labor to overhead. Cost accounting provides valuable insights that help companies optimize their operations, improve efficiency, and ultimately increase profitability. It's the engine that drives informed decisions about pricing, product mix, and resource allocation. Cost accounting answers a very specific yet crucial question. What's the exact cost to produce our product or deliver our service? This involves breaking down the entire production process, identifying all the associated costs, and allocating them accurately to each unit of output. This level of detail allows companies to make informed decisions about pricing strategies, identify areas for cost reduction, and evaluate the profitability of different product lines or services. It's about gaining a competitive edge through a deep understanding of cost structures. Looking beyond the present, management accounting takes a forward-thinking approach, assisting in strategic planning, budgeting, and performance evaluation. It's about using financial information to guide future decisions and ensure that the company stays on track to achieve its goals. Management accountants work closely with management teams to develop budgets, forecast future performance, and monitor key performance indicators, KPIs. They provide the insights and analysis needed to make informed decisions about investments, resource allocation, and overall business strategy. The central question that management accounting addresses is, what information do we need to make the best decisions for our future? This involves gathering, analyzing, and interpreting financial and non-financial data to provide management with the insights they need to navigate the complexities of the business environment. It's about anticipating future trends, identifying potential risks and opportunities, and developing strategies to maximize shareholder value. Management accounting is the compass that guides companies towards a successful future. Beyond these core branches, the accounting field extends into several specialized areas. Tax accounting focuses on compliance with tax laws and regulations, ensuring that companies pay their fair share while minimizing their tax burden. Auditing provides independent verification of financial statements, enhancing their credibility and reliability. And forensic accounting delves into the investigation of financial fraud and irregularities, uncovering hidden assets and bringing wrongdoers to justice. Each of these specialized branches plays a vital role in maintaining the integrity and transparency of the financial system. They are the guardians of financial truth, ensuring that businesses operate ethically and responsibly. Accounting principles are the standardized guidelines and fundamental rules that ensure financial statements are consistent, reliable, and comparable across different organizations and time periods. Think of them as the bedrock upon which all financial reporting is built. These principles aren't just arbitrary rules, they're the result of decades of development, refinement, and consensus building within the accounting profession. They provide a common language and framework for recording, summarizing, and reporting financial information. Without these principles, financial statements would be subjective, inconsistent, and ultimately unreliable. This would make it incredibly difficult for investors, creditors, and other stakeholders to make informed decisions about a company's financial performance and position. They are the guardrails that keep financial reporting on track. They create a universal grammar for the language of business, enabling global comparability and understanding, regardless of geographical location or industry. Imagine trying to understand a novel written without any grammar rules. It would be chaotic and confusing. Similarly, without accounting principles, financial statements would be difficult to interpret and compare. This universal grammar allows investors in New York to easily compare the financial performance of a company in London with one in Tokyo. It fosters transparency and trust in the global financial system. This standardization is crucial for facilitating international trade, investment, and economic growth. It ensures that everyone is playing by the same rules, promoting fair competition and efficient allocation of capital. The business entity concept treats the business as completely separate and distinct from its owners. This means that the financial transactions of the business should be recorded and reported separately from the personal transactions of its owners. It's as if the business is its own legal person, with its own assets, liabilities, and equity. For example, if the owner of a small business uses company funds to pay for personal expenses, this would violate the business entity concept. This separation is crucial for accurately assessing the financial performance and position of the business. It prevents the commingling of personal and business finances, which can lead to inaccurate reporting and poor decision-making. This concept is fundamental to maintaining the integrity of financial reporting. The cost concept, also known as the historical cost principle, dictates that assets should be recorded at their original purchase price. This means that even if the market value of an asset increases over time, it will continue to be reported at its original cost on the balance sheet. While this provides reliability and objectivity, it doesn't reflect the current market value of the asset. For example, a building purchased for $100,000 20 years ago will still be recorded at $100,000, even if its current market value is $500,000. The rationale behind this concept is that the original cost is a verifiable and objective measure, whereas market values can be subjective and fluctuate widely. However, it's important to note that some accounting standards allow for exceptions to this principle, such as when assets are impaired or when fair value accounting is used. The dual aspect concept, also known as the accounting equation, ensures that every transaction has equal debits and credits, maintaining the fundamental equation: assets equal sign liabilities plus owner's equity. This concept is the cornerstone of double-entry bookkeeping. For every transaction, there must be at least two accounts affected. For example, if a company purchases equipment with cash, the asset account, equipment, will increase, and the asset account, cash, will decrease. The total assets, liabilities, and owner's equity will always remain in balance. This concept ensures that the accounting records are accurate and complete. It provides a built-in check and balance system that helps to prevent errors and fraud. Understanding the dual aspect concept is essential for anyone working in accounting or finance. The consistency convention requires using the same accounting methods year after year for meaningful comparisons of financial performance over time. This means that once a company adopts a particular accounting method, such as FIFO or LIFO for inventory valuation, it should continue to use that method consistently in subsequent periods. This allows investors and other stakeholders to track the company's performance and identify trends. If a company changes its accounting methods, it must disclose the change and explain its impact on the financial statements. While consistency is important, it's not absolute. Companies may change their accounting methods if there is a valid reason to do so, such as a change in accounting standards or a change in the company's business operations. Conservatism guides accountants to choose methods that are least likely to overstate assets or profits. A common saying that encapsulates this principle is, "Anticipate no profits, provide for all losses." This means that when there is uncertainty about the outcome of a transaction, accountants should err on the side of caution. For example, if there is a chance that a company will lose a lawsuit, it should recognize a liability for the potential loss, even if the outcome is uncertain. Similarly, companies should not recognize revenue until it is earned and realized. The principle of conservatism helps to ensure that financial statements are reliable and that investors are not misled by overly optimistic reporting. It promotes transparency and helps to protect the interests of stakeholders. For managers, these principles aren't just theory, they're tools for understanding performance, ensuring compliance, and making strategic decisions. Strong accounting foundations enable objective assessment, fraud prevention, cost control, and confident stakeholder reporting. In today's data-driven economy, accounting mastery isn't optional. It's essential for business leadership. Master these fundamentals, and you'll have the tools to read between the numbers and drive business success.